From the financial centers of the world, this is Bloomberg Markets with Alix Steele and Guy Johnson.
It is 30 minutes into the U.S. trading day on this Thursday, June 30th. Here are the top market stories that we're following for you at this hour. Bye-bye the first half of 2022. The S&P suffers its worst half to a year since 1970, while energy and yields soar. Your playbook for the rest of the year. And recession fears mount. Consumer spending slows as prices stay high. Markets start to price in a rate cut by the Fed in 2023. And OPEC's gamble. OPEC Plus will add oil to the market in August, while investors start to question how much more oil the Saudis can get out of the ground and for how long. We're going to speak to Ed Morris, Citi Global Head of Commodities Research. From New York, I'm Alix Steele, my co-host in London, Guy Johnson. Welcome to Bloomberg Markets. Guy, in some ways, it feels like the market is taking the Fed very seriously. They are going to dampen down any kind of demand, and we're already seeing that in the data, and you're seeing that reflected in bond yields and the equity market.
Yes, equity market's off today. Massive bid in the bond market, which I think is fascinating. I wonder whether that's some of the quarter-end flows, month-end flows making their way through into the system. But nevertheless, there is plenty to think about. We have a decision out of the Supreme Court, the final big one that we are waiting for. It relates to the EPA. Let's get the details. We go now to the Supreme Court and Bloomberg's Emily Wilkins. Emily, what do we know?
So we know that this was a major ruling, and we're still waiting for details on exactly how big it is going to be. We know that this is certainly going to have an impact on what President Biden can do in actually getting his climate agenda done. This is over concerns on whether the EPA can regulate emissions from power plants. And the question is exactly how far the Supreme Court is going to wind up going today. I mean, they could go to the point where this is going to not only impact the EPA, but numerous federal agencies and really put limits on what a president's going to be able to get done.
So, Emily, to dig into the reading here, so the Supreme Court is curbing the EPA's climate authority. It says that the EPA cannot seek a shift to cleaner sources of power. And this really goes to the legality of what the Clean Air Act can really do. Does it regulate within your fence and what your emissions are, or can it regulate what kind of energy you have to use? And it appears that this potential decision is weighing against doing anything outside your fence.
And that is really going to limit what the Biden administration is going to be able to do. We've already seen their climate agenda stumble in getting through Congress. It's not clear that Democrats are going to be able to move anything, and certainly not clear they're going to be able to do so after the November elections, which is supposed to be in the favor of Republicans. And so this could make it very, very difficult for Biden to move forward with his climate goals. And it could really impact how the U.S. and to a certain extent how the U.S.'s allies see the U.S. in approaching climate.
Well, let's just talk about that. We were in Glasgow not that long ago. The U.S. was there. It was setting some pretty ambitious targets. Where does the rest of the world now go if the United States cannot follow?
Well, one of the things that President Biden wanted to do when he got into office was to kind of bring the U.S. back as a leader on climate in the world stage. And so you saw him re-engage with the Paris Accords, begin to talk about climate. But if he doesn't have a Congress that's behind him on this, and he no longer has the ability to do some of these major and significant regulations through the EPA, that's really going to limit what the U.S. is able to do. And in which case, allies might look in the U.S. and say, well, if they're not going to commit to sort of some of these higher goals that were planned, why should we follow along with them?
Yeah, and let's share some context here. This is West Virginia versus the EPA. And just for some background, so back in 2009, the Trump administration replaced the Clean Power Plan with one that really weakened what the EPA and what power generators had to do. Now, a group of states sued to block that Trump plan, and that is what this lawsuit is about. They won, and now West Virginia is repealing that lawsuit. So siding with West Virginia, in essence, is allowing the weaker Trump measures to continue forward. This is a 6-3 ruling, and the interpretation far-reaching means that the U.S. Clean Air Act is likely to keep the administration from imposing the type of wide-ranging emissions that the EPA had tried to do. Emily, I think this also begs the question, is this that the Clean Air Act is not the right vehicle for the EPA to impose restrictions, Or does this mean the EPA cannot at all impose restrictions? Because therein lies a very big distinction in the authority of what the EPA can do.
Absolutely. I mean, certainly the EPA was given authority from Congress under this Clean Air Act, under laws that were passed decades ago. What this ruling really questioned, and I actually spoke with West Virginia's Attorney General about this, he said it's not so much about climate for him. It's more about really the separation of the different branches of Congress, that Congress is the one that makes the laws. And so if Congress wants to regulate something, that needs to be from Congress, not from an executive agency like the EPA. So when I spoke with him, he really framed this in terms of a sort of whole of government. How does government work? How do Americans get their laws and their regulations? How much is from Congress and how much are from federal agencies? So for him, that's really what this whole entire lawsuit was about.
Emily, just to change tack just a little bit, the president speaking in Madrid a few moments ago at the NATO summit, saying that he backs filibuster changes to restore abortion rights. What's the situation in the Senate? How much authority is he likely to have there in order to make such a change?
Well, certainly it's a huge announcement from President Biden. He's one of sort of the very old school way of looking at things. He wasn't really in support of banning the filibuster or abolishing the filibuster the way that many progressives in his party called for. Of course, exactly what this means, it might not mean too much because it's not just Biden, it's actually senators now who have to agree to overturn the filibuster. And we've seen numerous senators, Senator Joe Manchin, but certainly other senators as well, who've said that they do not want to eliminate the filibuster. They're worried about what it could mean if Republicans take over the Senate, and they want to make sure that that precedent is in place. It's unclear if Biden changing tact on this will change some of the thoughts and opinions. We have already seen Senator Joe Manchin's perspective on this change. He actually voted against a bill that would codify Roe versus Wade in May, but then after the Supreme Court ruling, came out with a statement saying that he would now support such legislation to do so. So we know that they have 50 votes, but they still need to deal with that filibuster. And at this point, it does mean something that the president came out and called for it, but we really have to pay close attention now to what Senator Manchin and other senators want, because it's going to take all 50 of them, all 50 Democratic senators, to agree to actually change that filibuster.
Emily Wilkins of Bloomberg Government outside the Supreme Court. Thank you very much indeed. Let us return to our question of the day. This issue of when the Fed will actually start to cut rates. That is the question that we're trying to figure out. And basically implicit within that is the idea that we are going to have a recession, probably in the interim. How deep will that recession be? And will that recession be deep enough to drive inflation out of the system? Bloomberg's international economics and policy correspondent, Mike McKee, joining us first up to discuss this. From a market perspective, we bring in Kriti Gupta, Bloomberg market correspondent. Mike, let's talk about this. The market is pricing the possibility of 50 basis points of cuts next year. Given the data we're seeing at the moment and the uncertainty that exists, where are we in our understanding of how quick this cycle is going to be, this hiking cycle is going to be, and whether or not the recession will be sufficient to deal with the inflation problem?
Well, the way you phrased the question, Guy, I'm going to point to a quote from Jay Powell yesterday at that Centrist conference, where he said, "We now know a lot more about what we don't know about inflation." And that's kind of the situation here. We are seeing signs that some inflationary aspects, even on the headline side, are rolling over. Crude oil's been down for a couple of weeks now, and now we see wheat prices falling on this idea that maybe the Russians are going to let some of the Ukrainian wheat out. And so therefore, we might see by next year inflation come down to a livable level. But if you go back and look at what inflation, and here we are showing on the screen what inflation was like, it had been flat for years, for decades really, and now all of a sudden it jumps up. They want to go back to flat. So they'll keep the pressure on, but they may be able to let it come down a little bit, take some of the the rate rises away, but still keep them off zero.
Well, and Kriti, for the market, this is a huge whipsaw. I mean, literally 3 weeks ago, it was the Fed can get this under control. Then the Fed cannot get this under control. And now the Fed can get it under control again. And we're really seeing that within the markets. What are we pricing right now?
Well, it's interesting because when we talk about recession cuts, we don't really, or I should say rate cuts, we don't really talk about that as even an option, because one of the ideas here is that you want to tackle inflation. And honestly, you maybe want to hit that recession even harder. But basically, if you're looking at the markets, I'm going to do this through euro-dollar spreads, which essentially for a non-bond geek audience is essentially what's pricing in the rate changes or rate expectations in the next 12 months. And right now you're looking at it down by about 53 basis points. In fact, what they're saying that in the next 12 months, you are going to see the Federal Reserve cut rates and actually go lower and lower. And this is significant because it's not saying that this is happening immediately. It's saying that this is happening essentially in the summer of 2023. Whether or not that's right, of course, we know this pricing changes all the time, but at least that's what's slated for now.
Mike, what signal will the Fed be looking for to make the decision that it feels that it can cut rates? Is it that we are seeing the GDP numbers slowing down, i.e. growth slowing down? Is it that they now see their models predicting that we'll get back down to target, they're on trajectory to target, down to 2%? What I'm wondering is what clue should we be looking for? And I looked at today's PCE number, which did show a slight deceleration in inflation. What should we be looking for to understand how the Fed's reaction function is going to work during this period?
Well, you may just want to create your own model and put a lot of numbers into it, because that's what the Fed's going to be looking at. The PCE inflation core basis did fall a little bit, and I mentioned that we're seeing some inputs drop in price over the last month, but that's got to continue. The market is going to price, as Alix was just saying, they're going to price with a lot of volatility month over month as we see data come in, and the Fed only makes their predictions once a quarter. So there's always going to be something of a disconnect there. But the Fed wants to see the economy slowing down, and not just in any particular area, manufacturing slowing, consumer spending slowing, and hiring slowing a bit. They don't want a recession where the unemployment rate goes up big, but they do expect unemployment to rise a little bit. If all those things are happening and inflation's going down, then they can take their foot off the gas pedal, or the brake, I guess, is the official pedal that we're using right now. But until they see a broad-based slowdown, they're going to be holding back.
So if that's sort of what the model that we should all be using, which is like throw a dart at a board or something, Kriti, for the inferior investors, what are they doing? What's liquidity like right now? What are flows doing like end of quarter? And this big question hanging over all of us.
Well, this big question has been hanging over all of us for about 6 months now. It's been driving this idea that you need to have this repricing in the market. And it's a repricing that doesn't just go back to the gains that we've seen since 2020. It goes back even further to 2019, even, where you did see that tech acceleration. I will say, though, as far as we're looking at what the end of the quarter is, what the end of even these first half of the year is, a lot of this looks like 1962. Give me a second here. 1962 was, I mean, we weren't all around then, but known for the Cuban Missile Crisis, so it's not necessarily the recession talk, but you also have this kind of Cold War-esque in the background here. And in 1962, you had 9 straight months of decline in the stock market, only for it to get reversed by the end of the Cuban Missile Crisis. So I wonder how much of that pivot point is really the recession talk or the Fed, as opposed to perhaps an end to the war in Ukraine.
All right, guys, thanks a lot. Really appreciate it. Thanks for jumping in there. Bloomberg's Michael McKee and Kriti Gupta. I don't think Guy was even alive in 62. I'm just putting it out there. All right, coming up.
I was just waiting for that.
Coming up, what will future rate hikes mean for the credit market? We're going to get the inside look down with Jonathan Levine, Chief Investment Officer of Bain Capital Credit and co-managing partner of Bain Capital's next. This is Bloomberg.
The Boston Pops Fireworks Spectacular is back in Boston, and Bloomberg will make sure you don't miss a second of the fireworks. Music and special appearances by superstar Shaka Khan, Grammy and Tony winner Heather Headley, and The Voice winner Javier Colon, plus Middlesex Fifes and Drums and the Tanglewood Festival Chorus. It all starts July 4th at 8 p.m. Eastern, right here on Bloomberg Television and Radio.
The path back to 2% inflation while still sustaining a strong labor market. We believe we can do that. That is our aim. The bigger mistake to make, let's put it that way, would be to fail to restore price stability.
If we see greater persistence of inflation, that's second-round effects, then we will act more forcefully. As we respond to this shock, we want to have those options on the table.
I don't think that we're going to go back to that environment of low inflation. As the uncertainty will clear on various accounts, we will have to certainly be less gradual.
That was, of course, Fed Chair Jay Powell, Bank of England Governor Andrew Bailey, and ECB President Christine Lagarde speaking at Sintra yesterday, the ECB get-together. They were moderated, of course, by Bloomberg's Francine Lacqua. What a fantastic conversation that was. Where do we go from here is the question. What is our degree of certainty about what the journey is going to look like? Jonathan Levine, Bain Capital Credit CIO and Bain Capital co-managing partner, joins us now here on set. Jonathan, it's so fantastic to catch up with you. You always have words of wisdom, and you've always told me that I shouldn't predict, I should analyze. How easy is it to analyze right now? How easy is it to get a handle on what is happening? Because to be honest, we were joking before about the 1960s. I probably haven't been as this confused in a very, very long time.
So, a pleasure to be here. Appreciate your having me on. There's a lot to analyze. And one of the things when you do analysis is to make sure that you have relevant data, consistent data series, in a broad spectrum of things you're looking at. Inflation, as you talked about earlier, it isn't a single thing. It's the sum total of a bunch of other things. And one of the things we're looking at is different components. What is going on in the overall economy? What are we seeing in our portfolio companies?
Yep.
And we're not reacting to a data point. We're looking at data series. And sometimes, you know, people think they have to zig or zag, and sometimes it just makes sense to stand still and watch what's happening. And make sure that if your analysis, if you're confused, one, you don't have to invest in anything until you figure out what you think the right value is, the right direction is. But two, you better build in more margin of safety, and you better understand where your analysis could be wrong and how it could be wrong.
So, Jonathan, how can you do that if we don't have, do you have to have a call on whether or not the biggest risk is inflation or recession in order to do that well?
Well, I'm not sure you have to have a call on those things as compared to making sure that you are buying things that you can own through those things happening, that are well capitalized enough to be able to survive both an economic downturn or inflation. And I realize the obvious comeback to that is, well, then you're going to buy much fewer things, and that's probably true. The second thing is, it's all about valuation. When I look at credit spreads, they're obviously wider than they have been if they are predicting an elevated level of defaults. If we buy credit today, and let's say the cumulative default rate expected is 20% over the next 5 years, and there's only 12% defaults, well, then that was a good purchase because you bought at a good valuation. And therefore, we're trying to have way wider margins than we've ever had before. And where we think that inflation could destroy a company or it can't survive through a recession, those are probably things we're going to take a pass on right now. There's no need to be a hero.
No need to be a hero, but it is an investable market.
I believe it is an investable market.
Where do you see the pockets of opportunity? So many people come on and stand there. They go, you want to buy infrastructure, you want to buy healthcare, you want to buy those safe areas of the market. Is that the only place I should be looking?
No. I think that as you think about it, there's a couple of things. One of part of our investment style, particularly in our privates businesses, is we are investing in companies where we can have an impact, where we can help companies with growth, with cost structures, with strategic moves. So asking yourself, can I still do those things with a given company, particularly in industries that are out of favor? Secondly, it is somewhat about valuation. Am I buying at a level that if I'm not completely right on the 2-year call, but this company is more valuable dispositively in 5 years if we get the earnings right, if we get the strategic direction right, and we don't over-lever it? And then lastly, you see, particularly in credit markets, but you see it in all markets, that in times of high confusion, people overpay for quality. And that in and of itself is risky. That if everybody, flocks to the same asset class, and you're going to wind up, somebody's going to wind up holding the bag when it all trades down. So we really are taking a much more micro, company by company, industry by industry approach, and not being prescriptive that this is uninvestable and everybody should go pile in here.
So, Jonathan, what kind of then distressed cycle do you think that we're going to see? Like, what kind of bankruptcies? How is this different from an 08 kind of scenario? What do you have to run from? And then where does that create the opportunity?
So I think that the characteristics of the companies that are going to have troubles are a few. One is they're going to be levered to growth of some sort, and they imagine revenue growth but not cost growth, or they imagine some incredible outsized perfect economy. Two, capital structures are overweighted to bank loans. So the last few turns of bank loans are riskier than they have been before. Three, there could be situations that are, for lack of a better word, a little chaotic because documentation isn't as good as it used to be. And therefore, you want to make sure you fully understand where you are in the capital structure, who the other constituents are, and don't just assume, well, I'm in the bank loan, and that's just like a bank loan was in 08. And then lastly, I think there's going to be a real focus on real businesses that have a reason to exist, that you would want to be associated with 3 years from now and 5 years from now, and not just 9 months, oh, this is just a blip. It's a good company with a bad capital structure that'll clean itself up immediately. I think you have to have the mindset of being in it for the long run.
Are you already seeing the opportunities starting to emerge? The big question in public markets right now is, we've seen the valuation change, so we've seen that leg of the market downturn. Now do we get the earnings recession start to really kind of come through? Are you seeing that in the companies that you're looking at, in the companies that you're managing, and the companies that you're analyzing? Are you already starting to see the effects of higher rates, potentially slowing growth, already starting to have an impact? Where are we in the cycle at the moment?
So the maturity wall is actually quite low. And given that, large syndicated companies largely do not have covenants, they have some runway. The people who are going to get in trouble and are getting in trouble now are companies or business models that have gone for growth that rely on access to capital markets in the future.
Right.
Or even worse, access to capital markets at high valuations. And we are starting to have conversations with some firms preemptively almost, where they're thinking about, okay, we have these companies that may be running out of money.
Yep.
We don't want to put equity in. How would you approach them? So they're going to try to avoid the default.
Sorry, just to jump in. Does that mean that there is the opportunity when other options dry up that maybe actually private capital can come in? Just talk me through how quickly that can happen in some of these scenarios.
And this is a relatively new area, but there's a lot of tech firms that have no debt that are, have done the A round, the B round, the C round, and they're not designed to either be cash flow positive yet and never anticipated having to do down rounds. There's real enterprise value. There's real technology. There may be real customer bases in some of these. And therefore, for the first time, they may look at some private capital at the top of the capital stack to get them through the crisis, to get them through this time of uncertainty until they can have traditional access to capital markets. We did this once or twice during the 90 days that the markets were off on COVID. But we think that this is an area where a lot of growth firms, growth equity, are going to be looking to find non-equity sources of capital. And then secondly, there are people who embarked on big CapEx plans, real businesses, thoughtfully done, where the costs of what they're building are just way, way, way out of whack. And they're going to have to find different sources of capital to help pay for those projects.
Always interesting to get the analysis. Jonathan, such a pleasure to see you. Thanks for stopping by to see us here in London. Next time you're here, please do the same thing again.
Pleasure. Thank you.
Jonathan Lavine, Bain Capital Credit CIO. Interesting analysis. Coming up, U.S. consumer spending cools, inflation remaining elevated. We're going to get more on exactly what was in today's inflation data. Omar Sharif, founder and president of Inflation Insights, is going to be joining us next to break those numbers down and give us a clue as to how that reaction function over the Fed is going to be working with this data as they plug it in. That's next. This is Bloomberg.
All right, we're an hour into U.S. trading session. It looks like it's going to be an ugly session here. We're down almost a full 2 percentage points for the S&P. Abigail Doolittle is tracking some of those moves for us. Abigail?
Yeah, a bit of a brutal day, Alex. A brutal end to a brutal first half of 2022. In fact, right now, the S&P 500 down 21.4% on the year, and it is at 3,748, as you can see, below 3764.90. It is the worst first half going back to 1962. Above that level, it'll be the first worst half since, I believe, 1974. So either way, we're looking at the worst first half for the S&P 500 in decades as investors simply sell off stocks. That's true, too, for the Russell 2000, the worst first half ever. The SOX and the All-World Index down sharply. So it's interesting because this is a much worse first half than 2020. Who knew? But that's where we're at right now, at least. As for some of the worst sectors, not surprisingly, it has to do with some of the mega cap tech names. If we take a look at the sectors on the year, massive declines, down about 30% for the likes of tech, telecom, and discretionary. Think Apple, Twitter, Amazon, Facebook, Microsoft. They're all in these indexes, the big index heavyweights. As for one of the concerns, inflation. If we take a look at what's going on for inflation, there is some hope that maybe inflation has peaked. Here we have a number of different measures of inflation, including PCE, the PCE deflator, and then the 5-year break even, a look ahead at inflation. And you can see that all are sharply higher, but coming off the peaks. Let's see whether or not that trend continues. That could have something to do with our next board, which of course has to do with the potential recession that everybody's talking about, because the S&P 500, of course, a forecasting tool looking out, suggesting that the recession economists are talking about could be happening. These are two truly economically sensitive sectors, the industrial metals and the auto and commodity sector. You can see both down sharply on the year, suggesting that investors, Guy, think that, yes, the recession that folks are talking about could be ahead.
Yeah, but how deep will it be, and will it be enough to get the inflation that we're also concerned about out of the system? That's the question that we don't know the answer to. The 70s were a series of inflation waves. Are we ultimately going to go back in that direction? Because that wasn't a good place to be. So let's talk about the data today. Clearly a firm focus on the core PCE number of inflation-adjusted consumer spending in the United States. The data we got earlier, well, it was down in May. That's the first time that has happened this year. We are seeing persistently high inflation, and that clearly is feeding through into household budgets. So is this mild dip going to be enough, really, to change direction over at the Fed? Omar Sharif, founder and president of Inflation Insights, joins us now. Omar, your reaction to the data, it was a little off expectations, but not by much.
No, I mean, quite honestly, I think for the most part, it was very much in line, especially the inflation numbers. But is it enough to change course for the Fed? I highly doubt it at this point. You've got, slowdown in core inflation in the PCE, but core CPI still remains incredibly high. And Chair Powell has said this is not really a time for nuanced readings of inflation. They want to see it going one way, which is lower. And, just having the core PCE sort of standing out at 4% annualized right now, I don't think that's going to be enough to get the Fed to change course in terms of their rate hikes for the balance of this year.
Omar, can we dig a little deeper and get nerdy here on where do we see prices cool? And is that cooling sustainable? And where do we see an increase in prices? And is that increase sustainable?
Yeah, so where we're starting to see, some moderation, and as I know you've reported on sort of some of the inventory overhang in items like furniture and household furnishings, that's starting to bite a little bit in the inflation numbers. So more recently in both the CPI and the PCE, we started to see a pretty marked step down. That's a series that had been growing at almost 1% per month over the last year. It's gone down to close to flat now last month. So there's an area where you're seeing some cooling. used cars are, at least in the PC data, you're starting to see some moderation there as well. And I think in the CPI next month and going forward, we should start to see that cool as well. So in some of these good sectors, we are seeing some cooling occurring. And I think you'll start to see that in airfares, luckily, over the summer as well.
Amit, what people care about now is gas and groceries. The core is great, and yes, over the long term, it probably is the place to look in terms of understanding deeper inflation trends. But right now, it's headline inflation that the average consumer is having a problem with. Is the core the right place, therefore, to look in terms of understanding the direction of policy?
Yeah, no, I think that's a great point. And you're right, it should actually be the headline. I think Chair Powell sort of made this pivot a couple of press conferences ago, actually, when he started his press conference by basically saying that he wanted to speak directly to the American people. He said that the Fed understood the hardships that inflation was causing. And you can't understand the hardships without knowing what gas and food are doing. And so the headline rate in terms of CPI is about 8.6%, which, by the way, I think next month is going to go up to about 8.8. And on the PC side, it's still well over 6%. So if you're looking at those measures and you're the Fed, it's great that the core PC is slowed down to 4, but the headline is still unacceptably high. And I think that's another reason, given the Fed's pivot, their focus on expectations, that you'll continue to see them ratchet ahead with 75 bips in July and likely a couple of 50s before closing out the year, getting us into that kind of 325 to 350 range by year end.
Omer, what kind of demand destruction can we expect in that scenario that you're painting?
Yeah, I mean, we've only just begun to see some of it in, of course, in the housing market. More recently, yesterday in the EIA's data, you saw that we're running around 600,000 below sort of the norm in terms of gasoline consumption right now. I don't know if that's necessarily demand destruction, but certainly seems like high prices are starting to put a bit of a cap on gasoline demand as well. But I think for a lot of these items that, household durables, some items, larger goods that require financing, including, autos, you're going to start to see some of those numbers come down. We're starting to see it in used car sales as well. So I think these areas where, rates obviously bite, those areas are already starting to cool, and I expect you'll see more moderation as the year goes on.
Omer, the question I'm trying to understand at the moment is how deep does a recession need to be in order to drive the inflation that we are being plagued with right now out of the system? What are your thoughts on that?
Yeah, honestly, I don't know that we would necessarily need to, induce a recession to get some of this inflation number, some of these inflation figures lower. I mean, just in some respects, they are going to be headed lower partly because we are seeing some catch up in supply, some catch up on the inventory side. And in fact, we're seeing a lot of the inflation came from the durable goods part of the economy. Mm-hmm. And we are seeing a lot of that moderation starting to occur now. It's obviously way too early to declare victory, but I think we're going to keep seeing inflation moderate on that front in the second half of this year. And I think on the services front, quite frankly, you have one big item in shelter, which is obviously going to continue to sort of pick up given the lags in the data. But I really don't see broad-based services inflation sort of beyond what we're seeing in shelter. We've had a bit of pickup in airfares. I think that's going to come down. So I'm not really in the camp that says, hey, look, we've got to get a recession to get inflation lower. I think some of the hikes the Fed has already sort of done are starting to have an impact in helping to bring these numbers lower.
So what do you think clear and convincing evidence means for the Fed? To Guy's point, I'm trying to understand, does it need to be just a trajectory to get to 2%? Do we need to come down fast enough that we have confidence that inflation can at some point get to 2%? What do you think the qualifiers will be for the Fed to be convinced?
Yeah, so I think first of all, it's inflation, the actual data getting down to sort of in a 2 to 2.5% type range for several months in a row. So, even now, for example, we're talking about the core PC slowing down. We're still running at 4% annualized. So I think you want to get back down to around at least 2.5% type number for the Fed to feel more comfortable. You're going to want to see several prints in a row of that occurring. And then I think obviously they want to see some moderation here in terms of some of these supply chain issues. So you're going to want to see that easing up. Delivery times, for example, are starting to already come down in some of the regional factory data. You're going to want to see that continue to feel better about the idea that, hey, supply chains may not be as big of an issue in terms of pushing up inflation going forward. But I think the realized numbers have to come down to about at least 2 to 2.5. I think your projections have to also, sort of say that inflation over the next year looks like it's going to be kind of in that range as well. So I think those are the two most important factors, but also supply chain, you're going to have to see some cooling in that as well.
Omer, we listened to Jay Powell, Christine Lagarde, Andrew Bailey speaking yesterday at Sintra in Portugal, talking about this idea that we are in a new paradigm now for inflation. It may not be completely new, but it's certainly new to many of us. And that is that this era of persistently low inflation is now over. Would you agree with that?
I think it's a little too early to say that. I mean, look, we've had a couple of decades of, this environment of low inflation. We've had about a year and some change of high inflation. People sort of forget. I know it seems like inflation has been running at 8% for a long time, but this really only began in the spring of 2021. I mean, April, May, June of 2021 was really when you saw the big pop in the inflation data as durable goods spending really increased. So we've had this high inflation for about 14, 15 months or so. It's likely going to take another, roughly year, if not a little bit more, for us to sort of wash this out of the system, in my opinion. But I don't think after 1 year or a year and a half of data that you can sort of discount what we've seen in terms of persistently lower inflation over the last, call it 20, 25 years. So I don't know that it's a new paradigm. I could be proven wrong, but I suspect it'll be a long time before we can really look back at this and say whether or not there was some sort of paradigm shift. But in my opinion, it's just way too early to call that right now.
I have to wonder too, Omer, I know we're really jumping the gun on this, but is there a way that the inflation we're seeing potentially makes the disinflationary environment we have been in worse? And then all of a sudden, the supply chains for chips went crazy. So therefore now everyone's trying to make a lot more chips. And eventually that's cyclical and that'll be deflationary. You can make an argument the same thing will be said for pockets of energy. Look at certain retailers like a Target and a Walmart. They stocked up things they thought people wanted. It didn't work out. Now they have to discount it. And I'm wondering, like, in 2 years, will the after effect be much more severe on the downside?
Yes, I actually don't even know if we have to wait 2 years to see some of that. I suspect you're going to see a lot of it later on this summer. And to your point, you talk about Walmart, the Targets of the world. We've heard all the stories about inventory, going up 30, 40% versus last year, and you're already seeing the discounting occur. As I mentioned earlier, household furnishings, home furnishings, things of that nature are already starting to see price cuts. We're going into a period where Amazon's Prime Day is coming up in a couple of weeks. So we're going to go through a summer of, I think, heavily discounted items and durables for consumers. So I do think some of that buildup, where the over-ordering, prepping in case supply chains continue to be a problem, is going to really help bring down some of that durables inflation in the second half of this year. So I don't even think you're going to have to wait that long to see it in the data.
Omer, look, we really appreciate getting the deep dive into inflation with you. Omer Sharif, founder and president of Inflation Insights. Thank you very much. All right, coming up, let's get back to that breaking news from the top of the hour. The Supreme Court curbs the EPA's authority, and that deal is a pretty big blow to President Biden's climate goals. We're going to break down the implications of that ruling next. This is Bloomberg.
This is Bloomberg Markets. I'm Ritika Gupta. You're looking at a live shot of the principal room. Coming up, Ed Hyman, the founder and chairman of Evercore ISI, joining Bloomberg TV at a noon New York time. This is Bloomberg. Keeping you up to date with news from around the world, here's the first word. I'm Ritika Gupta. China's Xi Jinping has made his first trip outside the mainland in almost 900 days. Xi traveled to Hong Kong, calling the city reborn since he last visited 5 years ago. His comments were an apparent reference to the sweeping security law Beijing imposed back in 2020 that crushed dissent. Xi is marking the 25th anniversary of Chinese rule in the former British colony. Here in New York, police are searching for the suspect in the shooting death of a woman pushing a baby in a stroller. It happened last night on Manhattan's Upper East Side. The killer was described as a male who was wearing a black sweatshirt and black pants. Congresswoman Liz Cheney has warned her fellow Republicans that they must choose between former President Trump or the Constitution. She says they cannot be loyal to both. In a speech in California, Cheney called the former president a domestic threat the country has never faced before. Cheney is vice chair of the committee that is investigating the attack on the Capitol. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Alex.
All right, thanks so much, Ritika. So let's get a quick market check here because we're really picking up a little bit of steam to the downside. The S&P is now up by 1.7%. In fact, where we're trading right now, we're actually looking at the worst half of a year since 1962. Let's say that again, 1962, worst half of the start of a year for the S&P. The Nasdaq 100 obviously getting beat up quite a bit. You're looking at the worst start since 2002. The bid coming into the bond market on the front end, you're seeing even more money kind of come in here as we're reassessing how long the Fed can actually be hiking rates for and when they wind up needing to cut. Lower yields, not enough to help any kind of bid into tech. Particularly consumer discretionary getting really taken out, Guy. We had that weaker consumer spending data. We're clearly seeing the issue of higher prices affect spending, and that is definitely reflected within the stock market.
That 3% line on the US 10-year I find fascinating. We just had a little look below it. It's been a real barrier for the market, that 3% area. A significant push below it would, I think, at this point be quite significant. It's going to be interesting to see whether the market struggles to do that. But as you say, you're seeing money coming in at the front end. You're seeing it really around the world as well. It's not just the US that we're seeing this. German 10-year yields off 16 basis points today. Italy, 13 basis points. France, 12, 13 basis points. The UK, 12 basis points. These are really big moves. Some of it, Alex, is going to be quarter end, month end, all of that kind of stuff getting rolled in. But nevertheless, this is a significant amount of flow that we're seeing back into the bond market today as everybody tries to understand what kind of a recession we're going to see and what kind of reaction we're going to get from central banks as a result of it. How deep will it be? Where everybody's now like, we're going to get a mild recession. That seems to be consensus. But it wasn't that long ago that everybody was saying we weren't going to get a recession. Now it's mild. Do we get to severe?
And now we're talking about rate cuts. That was a totally different narrative than just like 48 hours ago. And the cuts are moving up now to 2023. But definitely we have to see how we settle out at the end of this trading day and sort of kick off a shortened week next week here in the U.S. That's going to sort of deal with volume and liquidity a bit differently. So it's going to be a little while till we're able to get a clean read, I think, on the markets. Let's get back to that breaking news that we had earlier in the hour. The Supreme Court is restricting the EPA's ability to curb greenhouse gas emissions from power plants, a major blow to President Biden's climate agenda. For more, we want to welcome Brandon Barnes of Bloomberg Intelligence, who's a senior litigation analyst there. Brandon, without getting too in the weeds, what was the case about and what did the Supreme Court rule?
Yeah, I think you can definitely get on the weeds with 4 different cases coming in together, et cetera. But really this was about, at base, can EPA regulate greenhouse gases at coal-fired, at fossil fuel-powered power plants, and how can they do that? We had competing rules going that way. And basically what the court said is, EPA, you tried to go too far when you were pushing the states to generation shift. You were trying to push the states away from those fuel sources into renewables, into other ways to do this, having credit programs. And now we're back into Trump's rule, which was the Affordable Clean Energy Act, and that is now the operative rule. And so we're in that status where you can regulate a power plant at the stack, and that's about it. Certainly expect that to be changed by the Biden administration as soon as they kind of come up with the next proposal.
So is the ball now back in Congress's and the Senate's area? If we were to see the legislative part of government now deciding that it wants to beef up the rules that the EPA operates under and the authority that it has, is it still possible to deliver these kinds of rules and change the climate trajectory?
Guy, that's right. I mean, assuming Congress would act, that is the pathway that the court outlined, right? They basically said, EPA, you can't go this far because Congress hasn't told you you're allowed to go this far. It's what they're calling the major questions doctrine. It's why we got a lot of interest from clients on this, whether this was going to be more far-reaching across a number of different agencies in the federal government. Certainly, Congress can speak directly to this. That's part of the court case, is they said, look, Congress has spoken directly to the cap-and-trade program by not passing it over a number of years, and that's exactly why we're in this place right now.
So what I'm also trying to understand is the tool and the arm with which the EPA was trying to regulate the types of energy the question, or the EPA in general? So can the EPA be tasked to create another tool that isn't the Clean Air Act to then try and regulate emissions, or is the EPA just like toast?
No, I think this is more limited than what maybe some of the headlines are saying. This is really about EPA, you can't use this particular piece of this statute to then pass this particular rule that does this. EPA can still go about its business doing regulations. It can still regulate greenhouse gases. It just can't do it in this manner, which is so-called going outside the fence line. Basically, you can't go beyond regulating single sources. You can't force a state to do more than that.
Where does it leave this idea that you can, which is what Europe is doing, set aggressive targets without the necessary technology already being in place to achieve those targets in order to spur innovation?
Certainly, technology forcing is a function of what the EPA tries to do with its performance standards, and that is still in play. That's part of actually the Trump rule comes back into effect now, that ACE rule, as I mentioned. And actually, it's more about technology that's available now for these different sources and how they can put them in place now. What's not available, which is interesting, is going to be a credit program, which we think is a net negative for renewables, because that would have been a nice subsidy from the higher pollution producers in each one of these states.
Okay. Back to Congress seems to be the takeaway. Brandon, great stuff. Thank you very much indeed for the analysis, the deep dive into what is happening here. Brandon Barnes of Bloomberg Intelligence. This is Bloomberg. So it's been a bumpy 6 months, and the last day of that 6 months is proving to be just as bumpy. So this is what the price action looks like right now. European equities down by 1.8%. We're trading 405, nearly 406 on the stock 600. I'm told by the technicians you want to watch out for around 403. But we're down by 7 points today, which is a fairly chunky move. The action, I think, though, is interesting here, but more interesting here. Look at what is happening in the bond market. Really big bid coming through into bunds today. Last 6 months, we've gone negative 17 basis points up to 1.7 basis points, 1.7%. It's been an amazing move, an amazing journey that we've been on. We're kind of mid-range right now, but as you can see, 14 basis points, only 15 basis points down today. So a really big bid coming back in. And the euro's coming back, actually, interestingly enough, this afternoon. 104.53 is where we are now trading again. Keep an eye around the kind of 103 level. Interesting that we're seeing a little bit of symmetry there. But certainly, there's a lot of people with some downside projections that still push the euro even further down from here, which then feeds into that inflation narrative. Coming up on the European close, what are we going to talk about? Jean-Yves Fillon, the CEO of BNP Paribas, is going to be joining us. The CEO of BNP Paribas USA, I should probably just clarify that, is going to be joining us in the next hour. Really looking forward to that conversation. The close is next. This is Bloomberg.